All right, let's jump right in. Today, we're talking about something called marginal costing. Now, I know, it sounds a bit technical, right? But stick with me, because it's secretly the key to making way smarter and way more profitable business decisions. So, picture this. You've just launched a brand new product. Awesome. But now you've got rent to pay, salaries, material costs, it's all piling up. The big nagging question is, how many of these things do you actually need to sell just to stop losing money? Answering that one question is what this is all about.
Well, the framework we use to answer that question is called Cost Volume Profit Analysis, or CVP for short. The best way to think about it is like a financial GPS for your business. It shows you the direct relationship between what things cost, how much you sell, and the profit you make at the end of the day.
And CVP isn't just one calculation, it's a whole toolkit. It's what helps you pinpoint that break-even point we just talked about. It'll help you figure out exactly how many sales you need to hit a certain profit goal. It tells you what your safety cushion is. And maybe most importantly, it shows you the real impact of selling just one more item.
Okay, the entire system of marginal costing boils down to one simple but really powerful idea. Every single cost in your business can be dropped into one of two buckets. On one side, you have your fixed costs. Think rent or salaries. These stay the same whether you make one thing or 1,000. On the other side are your variable costs, like raw materials, which go up with every single unit you produce.
And this brings us to the star of the show, the single most important concept in this entire explainer: contribution. This is the magic number. It's the amount of money from each sale that's actually left over to pay off those big fixed costs. And once they're covered, this contribution becomes pure profit. It is literally the engine of your business. And the formula to find it is incredibly simple. You just take the selling price of one unit and subtract its variable costs. What's left over is your contribution. Now remember, this isn't your profit per unit, not yet anyway. It's the amount each sale contributes toward paying down that mountain of fixed costs.
So let's see how this actually works in practice. With your very first sale, you generate some contribution. That money, and the contribution from every sale after that, goes into this imaginary pot. And the only job of that pot is to pay off your fixed costs, like rent. Once that pot is totally full, every single cent of contribution from that point forward is pure, wonderful profit.
In that moment, that exact point where the pot is full and your fixed costs are covered, that's what we call the break-even point. This is such a huge milestone. You haven't made a profit yet, but you're no longer losing money. You've officially covered all your expenses, which is the first major goal for any venture. So how do you find that magic number? Well, you use this simple formula. You take your total fixed costs and you divide them by the contribution you make from each individual unit. The answer tells you exactly how many units you have to sell to hit that break-even point. It's a direct, powerful, and honestly essential calculation.
Now, once you're past the break-even point, you can start thinking about your margin of safety. This is your buffer zone, your cushion. It's a measure of how much your sales can fall before you dip back into losing money. For a manager, a big margin of safety feels great. Maybe it's time to take a risk. A small one now? That signals it's time to be cautious.
Now this all sounds wonderfully neat and tidy, doesn't it? But you might be thinking, hang on, the real world is messy. It can't really be this straightforward. And you know what? That's a fantastic question. Marginal costing is a model, and like any model, it's built on a few key assumptions that we really need to look at.
Yeah, so this model relies on a few assumptions that don't always hold up. It assumes a constant selling price, but we all know businesses give bulk discounts. It assumes costs are easily split into fixed and variable, but some are kind of mixed. It assumes fixed costs are set in stone, but landlords can raise the rent. And it often assumes you sell everything you make, when most companies carry inventory. Now, this doesn't make the tool useless, not at all. It just means you have to use it with your eyes open.
Okay, let's look at a real puzzle. We've got this company, Tojo Ltd. When they calculated their profit, one method showed a figure that was 2,800 euros higher than the other. Same company, same sales, same period, but two completely different profits. What is going on here?
So, how is that even possible? It feels like it shouldn't be. The answer lies in a different way of looking at costs, and it reveals the true purpose of marginal costing. The entire difference comes down to one key thing: how you treat the stuff you made but didn't sell yet.
So here's the key difference. With marginal costing, all your fixed costs are charged against profit in the period they happen. Done. But with the other method, absorption costing, you take a little piece of those fixed costs and you attach it to each product. If that product isn't sold, its share of those costs isn't counted yet. It's carried over in the stock's value. That's why the inventory is valued lower under marginal costing, and that's exactly where that $2,800 profit difference comes from.
So, which one is right? Well, for official purposes, for your external financial reports, there's a clear winner. Absorption costing is the required method. It's what lines up with standard accounting principles, and it's what investors and banks expect to see.
So here's the real takeaway. These are not competing methods. They're different tools for different jobs. Marginal costing is your internal compass. It's for making smart day-to-day decisions inside the business. Absorption costing is the official map you have to show to the outside world. And honestly, a successful business needs to be good at using both.
And that brings us to the end. You now have the framework to understand your costs, to calculate contribution, and to find that all-important break-even point. So the only real question left is, with this powerful tool now in your hands, what decision are you going to make next? Thanks for tuning in.